July 30th, 2025. The Federal Reserve announces rates will stay frozen at 4.25–4.5%. Harry expected his SCHD shares to rocket higher. Instead, the price drops 1.61% that day while the financial planning world goes silent. By August 1st, SCHD sits at $26.35, down 4.17% year-to-date, while money market funds pay 4.15% risk-free. A fund with 14 years of rock-solid performance just shattered every textbook rule about dividend growth and interest rates. But here's what's really shocking. While retail panicked, one institution quietly loaded $1.03 billion worth of shares. What did they see that everyone else missed? I'm about to expose the 3 hidden forces that blindsided SCHD investors, and why this crash might be the wealth-building opportunity of the decade. We'll decode the real correlation between rates and dividend stocks using exclusive institutional data, reveal which policy bomb is quietly destroying SCHD's biggest holdings, and uncover the sector rotation that's reshaping retirement savings forever. Plus, the institutional trading patterns that will change how you think about passive income streams. Educational disclaimer. This video is for informational and educational purposes only. It is not financial advice. Common wisdom says when the Federal Reserve pauses rate hikes, dividend stocks celebrate. Lower borrowing costs, stable investment portfolio environment, happy income investors. But SCHD defied every rule, down 4.17% year-to-date, while Treasury bills offer 4.38% risk-free returns. Harry's watching his safe asset allocation strategy get demolished by cash sitting in money market funds. The math is brutal. Why accept equity volatility for 3.77% when you can earn 4.15% with zero risk? Something fundamental shifted in the money management equation. Let me destroy the biggest lie in dividend growth investing with hard data. Everyone believes SCHD moves opposite to interest rates. The numbers tell a completely different story. All ETF performance data in this video comes from Seeking Alpha. If you want to dig deeper yourself, there's a link in the description. $30 off plus a 7-day free trial. Here's the shock. SCHD's historical correlation with 10-year Treasury rates? Just 0.050. That's essentially zero correlation over the past decade. During the brutal 2022-2023 rate hike cycle, when the Fed crushed rates from near zero to 5.25%, SCHD only declined 3.26%, while the S&P 500 got massacred by 19%. But here's what changed everything. SCHD's current correlation reading is negative 0.151, slightly negative. When bond yields rise, SCHD actually falls. The opposite of what every investment research textbook claims should happen. This isn't about rate direction anymore. It's about yield competition economics. When 10-year treasuries pay 4.38% risk-free, SCHD's 3.77% dividend yield looks expensive for the equity risk you're accepting. The opportunity cost equation flipped. A JP Morgan study I've analyzed shows that during extended Fed pause periods, like our current 280-day freeze, value stocks typically outperform growth. But there's a catch. Only when fixed income yields aren't competing directly with dividend yields. Right now, money market funds paying 4.15% with zero volatility are stealing capital from compound interest strategies. That's the real financial independence killer. While everyone obsessed over Fed policy, a silent sector massacre was systematically destroying SCHD's investment strategy. Let me show you the data that exposes this concentration risk. SCHD's current sector allocation reveals dangerous concentration. Energy, 20%, 6x higher than S&P 500's 3.2%. Consumer staples, 18.3%. Healthcare, 13.8%. Industrials, 12.4%. Information. Technology, only 8.7% versus S&P 500's 31%. This sector tilt created a perfect storm when performance diverged. Year-to-date sector returns. Information technology, plus 12.7%. Industrials, plus 14.6%. Energy, plus 2.8%. Consumer staples, plus 4.1%. Healthcare, negative 3.0%. SCHD was massively underweight the winners and overweight the laggards. That's not money management. That's structural underperformance. But the real destruction lives in the top 10 holdings concentration. These names represent 41% of SCHD's entire portfolio, and their one-year performance reveals the carnage. Chevron Corp, 4.39% of fund, plus 0.42%. ConocoPhillips, 4.37%, negative 9.21%. PepsiCo, 4.19%, negative 14.34%. Amgen, 4.06%, negative 6.80%. Merck & Co., 4.05%, negative 26.29%. Texas Instruments, 3.85%, negative 3.03%. That's over 24% of SCHD's portfolio getting absolutely destroyed. When your 6 largest positions collectively underperform, even the best retirement savings strategy becomes a losing proposition. The few winners like Cisco, plus 45.19%, and Altria, plus 29.73%, couldn't offset the systematic underperformance of healthcare and consumer defensive giants. Here's the technical insight. SCHD's dividend yield of 3.77% is near decade highs, not because distributions increased, but because stock prices collapsed. That's a financial goals warning signal disguised as opportunity. August 1, 2025, marks the day policy uncertainty shifted from theory to reality for SCHD investors. President Trump didn't suggest drug price reforms. He demanded them with a 60-day ultimatum to 17 pharmaceutical companies. The most favored nation pricing protocol could tie U.S. drug prices to the lowest global rates. Historical analysis shows such controls reduce pharmaceutical profit margins by 15–30%. With healthcare representing 13.8% of SCHD's investment portfolio, this isn't academic theory. It's margin destruction. Merck and Amgen, sitting in SCHD's top 5 holdings, face potential pricing devastation. Investment research from previous price control episodes shows pharmaceutical companies typically cut R&D spending by 20–25% and delay new drug launches, crushing long-term growth prospects. But the policy assault expanded beyond healthcare. Tariff discussions resumed with serious momentum. Despite the EU trade deal preventing total economic war, the effective U.S. tariff rate is climbing toward 10% and could double if negotiations collapse. For multinational giants like PepsiCo and Chevron, core SCHD holdings, tariffs create operational nightmares. Higher input costs from imported materials, potential retaliatory measures in overseas markets, supply chain disruption and margin compression. The energy sector received mixed signals. The EU committed to purchasing $750 billion in U.S. energy exports through 2028, potentially boosting Chevron and ConocoPhillips revenue. However, renewable energy transition policies and drilling permit uncertainties maintain elevated volatility. This convergence of policy risks created an uncertainty premium that traditional asset allocation models couldn't price. The market demanded higher returns for increased political risk. Mid-video CTA. If this analysis is revealing the real forces behind SCHD's crash, hit that like button. The institutional money movements I'm about to expose will completely change your perspective. While Harry panicked about Federal Reserve policy, institutional titans executed calculated trades that expose SCHD's real investment thesis. The data reveals a fascinating strategic split. The massive accumulation, Kingstone Capital Partners, added 38.9 million shares worth $1.03 billion. WealthSpire Advisors increased holdings by 95.16%, 14.4 million shares. JP Morgan Chase & Co. boosted position by 9.66%. Wealthfront Advisors added 13.9 million shares. The strategic profit-taking Bank of America Corp. reduced position by 35.03%, 17.3 million shares. Sumitomo Life Insurance cut holdings by 30.76%, 8.25 million shares. Wells Fargo & Company decreased by 18.98%, 2.3 million shares. Net institutional result. Total shares increased 8.60% to 902.2 million shares valued at $22.57 billion. This isn't panic selling. It's sophisticated rebalancing with clear accumulation by growth-focused advisors while traditional institutions take profits. The insider trading patterns tell an even more revealing story. Corporate executives at Altria, Amgen, and Cisco, three major SCHD components, sold personal shares during Q2 2025. When company insiders reduce exposure while institutional money flows into the ETF, it signals a disconnect between individual stock outlooks and the broader wealth-building thesis. Here's the key insight. Smart money isn't abandoning dividend growth strategies. They're repositioning for recovery while fear dominates pricing. Let me synthesize this data into actionable financial planning intelligence using institutional-grade analysis. SCHD's crash. Despite frozen rates, resulted from three converging technical forces. Force 1, yield arbitrage breakdown. When risk-free assets yield 4.15–4.38% and SCHD offers 3.77%, the risk-adjusted return equation fundamentally breaks. Rational money management demands higher yields for accepting equity volatility. Force 2, concentration risk. Explosion. SCHD's 41% allocation to just 10 stocks created massive single-name exposure. When systematic underperformance hit core holdings simultaneously, diversification benefits evaporated. Force 3, policy uncertainty. Premium healthcare price controls and tariff threats added quantifiable risk premiums to SCHD's largest positions. The market demanded compensation for increased political risk. But here's the contrarian thesis supported by historical data. SCHD's current 3.77% yield represents the 95th percentile of its 14-year trading range. Previous yield spikes due to price declines have consistently generated superior forward returns for patient compound interest investors. The 280-day Fed pause we're experiencing historically benefits dividend-focused strategies once initial volatility subsides. Value sectors typically outperform growth during extended pause periods, precisely where SCHD's investment research methodology focuses. My technical rating: hold with strong accumulation opportunity. SCHD's dividend growth engine remains intact despite temporary headwinds. The underlying companies continue generating passive income streams while trading at distressed valuations. SCHD didn't crash because the Fed froze rates. It crashed due to yield competition, sector risk, and policy uncertainty. But institutional investors are buying while retail investors panic. SCHD's $26.35 price reflects fear, not failure. The companies still pay and grow dividends. This is a classic moment when wealth shifts, if you recognize it. Harry's learning. Quality dividend strategies survive storms and reward patience. Will you buy during fear or miss the rebound? Subscribe for more institutional-grade investment strategy analysis that reveals what smart money is really doing.